Could go live. Welcome everybody to Billionaire Acquisition Mastermind, #1 M&A podcast in the world. And today we have a special guest. We're bringing on SHAH, who is truly an expert in acquisitions, and he is here to share with you his insights on deal making and what to look out for. Now, SHAH is a C-suite professional with deep experience in innovative business-to-business and business-to-client technology companies. Mars has worked as a CEO or CFO and COO in multiple venture capital and private equity-backed companies, which includes 3 successful exits, including an IPO. His operating experience includes management of 600-plus professionals, M&A, profit and loss, revenue management of $300 million plus, commercialization strategies, institutional fundraising, turnarounds, and transactions over $5 billion worth of deals, and he's done about 70 acquisitions. Mars, glad to have you in this episode.
Thank you guys for having me. Great to be here.
Absolutely. So one thing I want to touch on, you yourself that has this vast experience has been involved in so many transactions, right? And started off just like many.
Yes.
What's the attitude of a deal maker? What does it take to succeed in this market? Because I like to tell people, cold calling business owners to spark an interest is one thing. Then negotiating the transaction is a whole nother world, right? Can you touch on that?
Yeah, definitely. And there's a few different components to M&A. Everybody obviously is aware of the financial and then the deal structuring and all that stuff. But there's a human psychology to deal making too, right? When you're acquiring a company or if you're a banker, selling a company on a client's behalf, it's really understanding that client, understanding their needs, maximizing enterprise value, and really getting down to what they want to do. So there's a big, human psychology component to M&A that not everybody's aware of, and it goes to the notion that people aren't rational; they're irrational in decision making. So there's a lot to that, and you have to take a lot of that into account, especially when you're doing, middle market M&A and lower middle market M&A.
Absolutely. Like I tell people, in the especially lower middle market, like you stated, business owners have an emotional tie with the business. The business is their baby. So there's emotions involved. Not only that, you got to treat it as such. You can't come in and be like, hey, 4 times, take it or leave it. You got to understand, what's the reason or motive of the sale, right? So moving forward, let's talk about board of directors. This is key. A lot of people, Mars, who are starting out, just like myself, we're taking the independent sponsor approach. And that has become very popular recently due to a flexibility in funding, right? Either commercially, could bring on investors, private equity, so on. Taking that into consideration, though, you're starting out from scratch. A lot of people are starting out from scratch. And, we need somebody, a team, to back us up, a team that has experience and the knowledge to achieve what we're looking to do. So do I have to build a board of directors, or will a deal team suffice? And what I mean by deal team is an accountant, a transactional attorney, an investment banker.
Yeah, for early on, a deal team would suffice. So early on, the goal is to really look and evaluate deals, and you want to have a process to do as many evaluations as you can. So, having a team of an attorney, an industry expert, a banker, I would say accountant, and more of a tax specific accountant, because a lot of M&A is really getting into the tax side of things. That would be your deal team. You don't need a board early on. What the board is really supposed to do is just keep the management team honest and hold them accountable. Early on, the deal team is essentially, a board in a way. So as you grow, as you get revenue, as you get a lot more folks within the company, then you can look to build out a board of directors who will hold the management team accountable, and that management team meaning the CEO, COO, CFO, etc.
Right. One thing I've been telling people, and correct me if I'm wrong, is that you take the board approach if you were looking to go public, but if you're looking to do a strategic private sale to a larger entity, right, or to a private equity firm, a deal team would suffice. Is that correct?
Yeah, as you go public, there's a lot that needs to really happen right now. The big issue on board is really having diversity as well, right? You're seeing a lot of companies who've only had all male white, Caucasian white boards before. They're really changing their perspectives and their board, rationale and selection. They want women, they want diversity focus, just so there's diversity in thought, and that's the biggest thing for board of directors as you get larger, as you scale, and eventually when you're a public company.
Absolutely, great point. Yeah, no, that is critical. Diversity in your board. So I want to ask this: what do you want to look for in a potential board or deal team member, apart from experience, right? Because there's a lot of qualified people. Is it more so the attitude of the person?
It's the attitude, the savviness, the confidence. It's who can get what it needs to be done to close a deal. And I think the ideal person and a really good deal maker is not just a financial, engineer or somebody who's financially engineering companies, but it's somebody who's also been an operator, right? When you're doing an acquisition, you don't really realize a lot of the intricacies when you are a banker. But once you've been an operator, if my company grows from 15 to 100 million in revenue, I had to take on a whole bunch of more cyber insurance. I had to take on a whole bunch of more E&O insurance. So a lot of M&A bankers don't really realize that they're just financial engineering companies, but a lot of operators do. So the ideal skill set is somebody who's been a banker or a corporate development person, but also been an operator who can see both sides of the table.
Right. Would you say the operator could come in as the industry expert, especially looking for industry experts? I look for people who've been, involved in high level management positions in large companies. Based on the industry I'm looking to get involved, right? They have more of that management role, like a COO type person.
Yeah, that's a really good point. The last deal I just did recently, we were looking at a company that was in the CPG space. We brought on an industry expert who was a senior exec before at Costco and Target, and he kind of just walked us through, what to look out for, who should be looking out for. That was really helpful having an industry expert, just to somebody who can give you the lay of the land and have a lot of the relationships in that industry.
Right. Okay. I have this question. Um, are they considered a board member if they don't if they don't have equity or a stake in the company?
It depends. So a lot of early stage companies are the biggest tool or asset you can give a board member is equity. When companies start to mature and have cash flows, you can start to pay them compensation, quarterly earnings, annual earnings, etc. So early on, there has to be some kind of incentive for a board member, and most companies early on don't have a lot of cash flow, so they give equity. That's the most premium product they can give. As companies mature, they can start to give, quarterly payments, bonuses, etc. So there has to be some kind of incentive model and alignment for that board member.
Right. Let's expand a little into, how do board members get paid? So, from what I was told, is initially, as you're starting out, it'd be a cash bonus post transaction with options to salary as we grow. Are there any other things you could compensate them throughout the process?
You can also give them potential equity in the acquisition you're looking to make. And if it's let's call it a new co, once you make that acquisition, you can say you as the deal maker and that holding company will hold most of NewCo, but as the board member, you may be able to get a certain smaller percentage of NewCo. So that's one tool you can give. You can also give certain things in terms of like bonuses based on milestones. So if you acquire NewCo at X valuation and that person was able to either help you bring it down and negotiate a lower valuation, you can give them a bonus in terms of, what was that X percentage that we got that transaction down to at a better price. So there's creative ways to really give board members milestones and bonuses based off of milestones.
Right. One thing that's big is a lot of the members are looking to acquire more than one company, so they're not looking to get stuck in
Mm-hmm.
the day to day. For that, we'd have to bring in a CEO. When do you think is the best time to bring them in, and how should we compensate them?
Yeah, early stage company CEOs are you want to have somebody on the ground early on. You don't have to call that person the CEO. It can just be an early stage management person. But as the company matures and as the company needs direction in terms of what what to go acquire next, setting the company culture, working on financials, etc. So you don't need a, quote unquote CEO early on, but you do need a CEO as a company starts to mature and really, working on scale, working on company culture, hiring processes, etc.
Right. In regards to, D&O insurance, you said cyber insurance as well?
Yeah, there's a lot of things that companies, mature companies take out. So you have E&O insurance, which is general business. There's cyber, liability coverage nowadays. Everybody has that because everybody is online, right? So you don't want any kind of privacy breach. There's also D&O coverage for directors and officers or folks who are on the board. There's also other things like key man insurance, for when somebody is really tied to the business. A lot of CEOs have to take this policy out.
And is there like a certain base amount to start off with that you think makes sense?
You can usually do like $500,000 or a minimum of $1 million of liability coverage, and that's not too expensive. As your company gets bigger and has a lot more revenue and a lot more liabilities, you have to increase those liability coverages, and that thus in turn increases your premiums.
Right. And is that per member or the board as a whole?
That's the board as a whole.
Okay.
So D&O is
uh-huh.
only for the board. The
Okay.
other liability coverages that I mentioned are for the company.
Okay, I see. So let's talk a little about acquisitions. Now, first of all, what would be your criteria for a potential acquisition target? And let me share with you mine. Okay.
Yep.
So in the lower middle market, we're looking at businesses minimum $4 million in revenue. I was looking at 1 to 3, 1 to 5. The issue with the smaller transaction is that there's less cash flow. After speaking with investors, they look for about $1 million in earnings or 1.5 million in EBITDA. The more cash flow, the more stability, security, systems, processes, right? So let's say 4 million revenue to 20 million. We look at profit margins of about 20%. We look for, there's no major volatility in the past years, excluding COVID. And then looking at COVID, how did COVID affect the company, for how long, and were they able to bounce back, and how much did they recover compared to 2019? Also taking that into consideration, I'm looking for a majority shareholder because I'm just negotiating with one person, maybe two people. It's better. Partnerships or structures where there's many involved, many shareholders, becomes complicated. I'm also looking for, management in place and the owner to stay on a transitory period, either in an active role or as a consultant for the next 12 months. And I also want to take a look at the contracts, how steady they are. So would you say, are those correct parameters to look at, or would you add or remove to add?
Yeah, I think you covered most of them. I think, from just a pure revenue, profit, and valuation standpoint, if you're going to look at smaller, entrepreneurially owned companies, there's not going to be that much cash flow to pull out of the business. They actually go off something called SDE, which is seller's discretionary earnings. It's similar to, just net profit, but you kind of normalize the expenses out of the business. What you really want to look for is, if you acquire a company, what are, expenses that you can really pull out of the business so you can get to something called an adjusted EBITDA. Adjusted EBITDA is taking out, non-recurring and one-time expenses so you can understand what true profit looks like. Other things to look at when evaluating a company is, yes, who is on the management team? And usually what you do is you do something called an earnout. So let's say if you're paying for a company and the valuation is 10 million, let's say you pay 2 million in cash and the rest you pay over an earnout. So you want that earnout tied to the folks on the management team or that or that founder or that CEO. And usually that comes with an employment agreement. An employment agreement, well, let's say it's 3 years. That means for 3 years, that person will be there with you, and then they'll get paid that $8 million on that earnout over 3 years based on milestones and metrics and achievements that they hit.
Right. Now, something I want to touch on is that we look to employ seller finance, right? Reason is it eases on capital gain taxes for the seller. And also some sellers are looking to retire. So you could create a sort of retirement plan where you could, amortize the note over 10 years, 7 years. Taking that into consideration, what are your thoughts about seller finance? Is it something, that is good to employ in a transaction?
I think so. I mean, usually all, I would not say all, but a lot of middle market and lower middle market deals are seller finance. It's similar to kind of like an earnout structure where things are tied to, milestones and metrics hit, and it kind of protects and mitigates everybody's risk, right? That's what everybody's looking for to do in any kind of investment or acquisition. Is how do I mitigate my risk? So seller financing does that. It also there's also some kind of interest rate tied to that transaction too, and you're looking at anywhere from potentially 5 to 10% of interest over, as you mentioned, a 7 to 10 year loan. So those are the typical terms when you look at a seller finance transaction.
Right. One thing I want to touch on is in regards to equity that is given to the board members. In regards to a vesting schedule, is 36 months standard for equity to vest?
36 months is about right. So usually it's anywhere from 3 to 4 years with something, a lot of the times they'll have a 6 month or 1 month cliff period. So 3 to 4 years standard vesting schedule, and sometimes you'll have a 6 month to 1 year cliff period.
Right. We had on an attorney last night, and he was touching on something in regards to seller finance. See if you could expand on it. But essentially, he was saying enforcing reps and warranties, and treating the seller finance as a liability clause. So if anything pops up, any skeletons in the closet happens, you could deduct their holding equity or not pay. Another thing he touched on was you could tie the seller finance to a contract. What I mean by that is that if there's contracts and they're not really stable, but the seller wants to get paid from that contract, you could tie his equity portion to it so he's liable to that contract if it falls.
Yeah, what you're doing is you're kind of taking away a lot of just that cash flow risk and you're tying it to other assets, right? So in any kind of contract, what would happen is when that when the money comes into the company, then the seller gets paid back a portion of that AR coming back into the company. So it's really like I mentioned, it's kind of hitting metrics, numbers all around that earnout or kind of that heavily structured earnout transaction. So that's how everybody's trying to do this and mitigate their risk on both sides.
Right. Circling back to the vesting, can you expand a little more for those that don't understand what it is or how to go about it with your board members?
Sure. So let's take, for example, I'm going to join the board of your company, and you say, Mars, thank you for joining my board. I'm going to give you, 5% equity vested over 3 years. So that means, for 36 months, I will get, each month I will get 36 divided by 5 in terms of equity per month, and that'll come out to in 1 year I'll have a third of 5%. In 2 years I'll have 66% of 5%, 2/3, and then in my last year I'll be fully vested and earn that whole 5% of equity.
So it's structured like an earnout, so to speak, right?
Not an earnout. Actually, yeah. If you think about it in that sense, yes,
Mm,
you are. There's a timeline till you fully get the whole thing. So yeah,
right.
it is. And these vesting schedules, earnouts are a little bit different. They can also be semi-annually. They can be quarterly. Typically, vesting schedules are monthly.
Okay, I see. In regards to buybacks of the equity, how can we get it for essentially people touch on pennies on the dollar. Reason is the company is still private, there's no liquidity for that equity, right?
So you can do something called a 409A valuation. A 409A valuation, what happens is an independent third party looks at the cash flow of the company, does an enterprise analysis and valuation, and they say the company is worth, X. Usually the biggest thing that people go back and forth in negotiating is valuation. If I'm a buyer and you're a seller, we go back and forth. What we do is we say, let's leave it to a third party to value what the business is really worth. And then we can talk more about buying back equity at that price.
Right. What are the most common ways of buying a business? Asset purchase or stock, and why? So let me just expand a little. The attorney we brought on last night, I asked him the question, do we need to buy the stock of the business if the business has a license? He was saying not necessarily. What you could do is create a new entity and acquire the assets and merge it to a new entity. You can even take the naming rights, basically have the owner on and operate under his license for the period of time you get your own. Can you touch on that?
Yeah, a lot of transactions in middle market and lower middle market done via asset purchases, because a lot of what you're buying, it could be client contracts, it could be office furniture, or it could be proprietary technology that you're buying. And usually, what happens is the seller is still the main holder of that entity, and they are essentially just selling assets and other products within the company to you as the new buyer. So it's just easier, and it's done on something called a cash-free, debt-free transaction, where the seller still keeps the cash in the bank account, but they also have to still maintain all the liabilities on that bank on the balance sheet as well.
Right. So when and why would we do a stock purchase? Is there any use for it?
Stock purchases do have uses, right? So if it is an actual entity or company that you want to buy, if you want to buy proprietary technology, if you want to buy the team, if you want to buy a lot of different things in the company, instead of just starting something from scratch, you would buy the whole thing, really integrate it in, and then just scale it. But then you would also have to assume the liabilities, if there are any, and then also you get the cash on the balance sheet.
Okay, so let me give you an example. I look to buy a physician office, right? And seller's looking to retire and wants to cash out. So I'm looking to employ an asset purchase so I don't take on liabilities. I take the equipment, I take the customers. Is that the clients? Is that correct?
So the client would be the customers. That would be considered an asset. So
Okay.
Buying any kind of client contracts or any kind of customers, that would be considered an asset purchase.
So basically, I'll be taking on the cash flow of the business moving forward, right? Because I have everything that is used to generate that cash flow. So if we're looking to do an asset purchase,
except so, but you don't have everything, because you don't have the least of the medical practice. You don't have the cash on the balance sheet. All that stuff is a liability that's held with the seller in an asset transaction.
Okay, so let me ask you this.
All that stuff can be negotiated, but yeah.
Okay, so if the seller owns a building, can I negotiate to use his building to keep operating, or would I have to move the assets or the equipment to another building?
No, you can negotiate it. You would just become a subtenant, or you would sublease that facility from that tenant.
I see.
Who is the owner of that lease.
Right. So we look to use cash flow based lending as our primary source for the loan. If we're going the asset purchase, can we still go that route?
You can't. No.
You can't?
You can't. Yeah, you cannot. You can't.
So only by doing a stock purchase, I could do a cash flow loan to finance that transaction?
Correct.
And why is that if I own the assets and everything that is used to generate that cash flow? Or is it, treated as a new entity?
It's treated as a new entity.
I see. Okay. So this is big. Mergers. One thing is acquiring the business. Another thing is if you're looking to merge it. What I've heard is that what usually makes or break the merger is not usually the numbers, but a culture clash. How would you go about maintaining the culture?
Yeah, sure. That's the biggest thing they say. Most of M&A fails not because of numbers or cost savings or any of the financials. It's because of culture, and it's really the most impactful and meaningful thing post sale and integration. So that's really just keeping cultures aligned. A lot of companies have different cultures, keeping them aligned, maybe potentially hiring in an organizational change consultant to really help you with that and make sure you maintain those cultures, or you merge different cultures together. And then what happens is when cultures aren't aligned, you'll just have a big exodus of people leaving. So you want culture to be aligned, you want incentive models and compensation to be aligned, and people to be really motivated the same way.
Right. Circling back a little to the deal structures, can you touch on SEC Rule 332, treating a stock purchase as an asset purchase for tax purposes?
Can you repeat that? I didn't hear the last part you said.
Yeah. Can you touch a little on SEC Rule 332, treating a stock purchase as an asset purchase for tax purposes?
I don't know too much on that.
Hmm.
I know high level, just why you do certain asset purchases versus stock purchases. There are certain things where you can do on depreciation of assets in an asset sale versus a stock purchase. So people use more tax friendlier methods because of an asset purchase on depreciation of assets,
Right.
and especially around capital gains and things like that. But I don't know too much on Rule 332.
Okay, no problem. So we touched on this the other time we had our little intro call, but you have experience dealing with private equity. How would one go
Mm-hmm.
about it to be able to team up with a private equity firm and become a deal searcher for them, right?
Sure, sure. What private equity firms really care about is somebody who really kind of speaks their language and does analysis reporting the way they do, right? So if I was going and reaching out to different private equity firms, what I want to do is I want to have a process in place when I go to evaluate companies and look at deals. And I want to have a clear and concise method of evaluating that company, having a diligence process, and then being able to present that to the private equity company with lots of different reasons why I think I want to buy it, what are the pros and cons, what's my investment thesis. So it's really about having a process in place to show PE firms that you have a good way to funnel companies into that pipeline.
Right. And not
And
only
you
are
want to
you,
you want to
hmm no,
and
sorry.
and you want to clearly understand their sectors of expertise, what's their investment thesis, why it aligns to some of the things and deals that you're looking at.
Right. So if you become a deal searcher, are you also negotiating that transactions or do they do a negotiation?
No, they'll do that because they're the ones with the capital. So
Okay.
when it comes down to it, you may be incentivized to help them negotiate it, but when they're actually putting up the capital, they're going to be the ones who dictate what that structure looks like, what the valuation is. You will be more of like a business development person looking at deal flow for them.
Right. Now, for those who are independent sponsors and negotiating their own transactions, can you provide a little, a couple tips or insights regarding negotiating with lower middle market businesses, right? The business is their baby, so to speak, right? How can you go about it?
Yeah, these are, the biggest thing is you want to make these really, you want to have at least a few years worth of numbers. So really get deep into diligence, do your diligence, understand, at least have 2 to 3 years worth of financials to look at, understand their client concentration risk, understand what their, any kind of pending legal litigation on liabilities on their company records, understand the management team as a whole. So, those are some things just to be aware and look out for. Most of these transactions and structures are heavily structured. So when you are evaluating or making any kind of negotiation on these companies, you do want to give folks more of an upside. So if you think the company is worth $10 million, you want to say to the founder or that entrepreneur, I'm willing to give you more, 12 to $14 million if you hit a lot of your goals and KPIs above and beyond over the next few years. And I'm not going to give that all to you in cash. I'll give that to you all via an earnout, and I'll give you a small portion of cash at closing.
Right, like an incentive, correct? So,
Exactly. And now,
mhm.
and now that founder, that CEO is like, okay, if I hit it out the park, I walk away with $15 million instead of $10 million if I do everything and go above and beyond.
Right. Let's touch a little about the financial side of things. Now, in regards to make your offer look at what's the income, do you look at it from the profit and loss statement or do you look at it from the taxes?
It's a little bit of both, right? So you obviously want to look at P&L, but P&L, remember, it's not proactive; it's retroactive information. So P&L is going to help you in terms of just understanding cash flow and EBITDA. People really fail to look at the balance sheet. Balance sheet is very important in terms of cash on the balance sheet, in terms of equity, in terms of liability. It'll really help you understand how much is on the company and what you can do post acquisition. One thing that most people want to maintain and have on the balance sheet is at least 90 to 100 days of working capital, which the formula is just your current assets minus your current liabilities. So if you take on a new acquisition, you want to make sure there's at least 120 days of working capital on the company's balance sheet for you to run the company.
Right. One thing I want to touch on is the valuation method. So, a lot of brokers, a lot of people touch on EBITDA. Like I was telling you, we're looking for what's the free cash flow, right? Now, in EBITDA, depreciation is real. You pay that with real dollars. There's taxes, there's
Mm-hmm.
interest, there's amortization. I was reading EBITDA is non-GAAP. It's a non-GAAP method of evaluation. That means you got to see what they add back to it, right? A lot of people add more than just what the name states. Now, I was reading there's this other evaluation method that is mostly used by analysts. It's called NOPAT, net
Mm-hmm.
operating profits after taxes. Would you say that's a better approach to go at it?
This is so we this is pretty good conversation to have. Like one of our teachers in business school is always a proponent of NOPAT because it's really looking at profit after taxes. And we would always, all of us folks who work in PE, would say we always look at it at EBITDA, right? So the reason people look at it, EBITDA is just industry wide and understood amongst all the folks who are in. Our teachers like the best way to really look at it is understanding cash flow and using a method similar to Notepad. So, you know, I think it is better to look at it from a Notepad method, but how are you going to compare to everybody in the industry who's looking at it in terms of EBITDA? So it's really just once the industry starts to convert more into that methodology, then you can use that. But for the time being, to be relative and have different kinds of benchmarks, it's going to be EBITDA level.
Right. So you just don't want to focus on one method. You want to have comparable different valuation methods, right?
Exactly. And you can also do, your traditional DCF method. You can look at like comparable transactions in the market, like lower middle market transactions. There's not that much analysis done on them, right?
Mm-hmm.
If I'm a seller and I sold my company for 8 times EBITDA, chances are you're going to say if you're a seller in a similar industry, you're going to use that as a benchmark. You're going to say the minimum I'm going to get for this kind of transaction is 8 times EBITDA. So that's another, big one is comparable transactions in the market.
Right. So net income, and I just figured this out, there's pre-tax and after-tax. How do you figure out which one is which?
So pre-tax is, it's what you essentially call EBIT, right? So looking at it in terms of your earnings before your interest and taxes, and then you're saying what are the different tax rates and different structures that we can have. There's also, it's one thing right now is you're going to see a lot of things start to change with the new presidency coming in, right? Trump is business friendly tax rates were a lot lower. Biden's probably going to come in, change things up. You're going to see tax rates increase again. So, it's going to have a big impact on M&A and consolidation. That's why you're seeing, I honestly think that's why you're seeing so much consolidation right now going on in the industry and just the world as a whole, just because no one knows what's really going to happen with Biden coming in. Once tax rates start to change, interest rates start to change, financing is still cheap right now. So it's the driver for a lot of, transactional deal things going on in the world right now.
Right. Taking Biden and his new implementations tax proposals into place, would you say once interest rates are higher and taxes are higher, would seller finance be the better route because you can negotiate better terms?
Yeah, it's. I mean, if you go try to get financing in the open market, um, it's going to be expensive, right? You're going to see rates kick back up. You're going to see people really find it hard to go out and get, different types of debt, mezzanine debt, et cetera. So, it's seller financing is a way for you to negotiate. It doesn't have to be industry standard or industry benchmark. It's just you and that person really negotiating back and forth.
Right. So now this is big. If you have a potential acquisition target, let's say I got a deal I'm looking to acquire. We're at an LOI stage. We agreed on a price that's fundable, a structure that makes sense, right? And we're looking to fund 70% with commercial debt, 30% seller finance. Banks still require 5 to 10% equity infusion from our end. How can we go about closing the equity gap?
Right now, what you can do is there's a lot of just private capital sitting around on the sidelines. And this has really happened for the last 7 to 10 years. There's ways to go get that equity capital. You can get that from a high net worth individual. You can get that from a family office type, and they're willing to invest, big chunks in these kind of private equity like transactions. You can get, as little as 500,000 or as upwards of a few $1 million. to have equity collateral for these kind of debt financing transactions.
Let me touch on family offices. I haven't heard many people talk about it. How would you go approaching them, and what are they looking for? You know, are they just interest-based lenders? Are they taking equity in the transaction?
Yeah, so family offices are, it's somebody usually who's been an operator and they've accumulated some kind of wealth, and they are, a little bit more free in what they want to invest in. So they'll do some in the public markets, they'll do VC like transactions, PE like transactions, but they don't have any LPs that they report or work into. It's just they have their own pool of family money and they invest. So they're looking for, they are looking at debt type transactions. They're also looking for debt type with some kind of warrant or equity coverage. They'll also play in the equity space, where they go and look at pure equity transactions. They're coming earlier down in the life cycle of a company now as well, and looking at seed and VC type transactions too. So family offices have really grown their investment thesis and profile over the last 3 to 5 years.
Also, would you recommend somebody to reach out to them for that equity portion? Start talking to them now?
For sure. Like, you can probably get better success with the family office nowadays than a PE firm. Because remember, PE firms have people that they report up and work into, which are the limited partners. Family offices don't have a limited partner. It's their own pool of capital. So you're directly negotiating with the boss.
Oh, wow. That's great. I appreciate those insights. Um, Big thing. What are major differences you see between evaluating small businesses and larger businesses, other than the cash flow? I know, the larger the transaction, would you say the longer it takes? There's more party involved. There's more to look out for. Would you say there's more things that could make or break the transaction, so to speak?
I would say I've done public transactions and private company transactions. The process is still the same, right? You go from an NDA, then you go from the DCF analysis, then you go from an LOI, IOI, then you get into diligence, and you get into the purchase agreement. So the process is still the same. It just depends how long that process is going to be, right? A small transaction could be done in 6 months. A publicly traded company transaction could be done in 2 years. And what happens with publicly traded transactions is there's just a lot more people involved in terms of attorneys, regulatory authorities, SEC is involved. So it's just really more regulatory and compliance that holds up a lot of things. And you just have more people involved. You're dealing with, if you're a Ford Motor Company and you're doing transactions, your legal counsel is involved, and you've got your board of directors involved, especially for big deals. So it just adds more cooks to the kitchen.
Right. Very briefly, you said LOI and then you said something else.
Yeah. So the LOI is a letter of intent. So that is my intent to purchase a company. And then you get into something called due diligence once you submit that LOI. And then the final stage during diligence, you submit something called an asset purchase agreement. That's the agreement to go buy the company, your APA.
APA. What about the PSA? The purchase agreement.
What's that act? Yeah, same thing. That's
thing?
what I meant. The purchase agreement. Yeah.
Okay.
The asset purchase agreement. Yeah.
Great. Now let me ask you this. This is big. Everybody talks about pre-acquisition. What happens post-acquisition? After you buy the business, what are things you can implement to make sure you hit the ground running, you're off to a good start?
Yeah, they call it like a 100-day plan. When a new president comes into office, he or she has a 100-day plan. Private equity firms and investment officers follow the same kind of thing. You just spend all this time in diligence looking at what to buy. Now you just acquire it. It's like, what do you do now, right? So now it's understanding more about the financial controls in place, understanding the technologies, understanding the people, understanding any of the regulatory legal litigation. So having a plan to combat all that. The other big thing is, how can you perform a synergistic cost analysis and start to implement that? So what are some things that you can slash and cut right away, which will help you in cost savings and cash flow? So it's really having that detailed plan about each department on what to really accomplish in those 100 days.
Right. Let me touch a little on working capital, right? Every business needs it. So not only can you get working capital with the seller, and that's something you can negotiate, but I've seen transactions where we could get the deal at a very great price, where our DSCR is above 2 times. We got 2 locked in. One's 3.6 times and the other one's 2.8 times. which is really great. And these are broker deals. I've never seen something like that. Taking into consideration the surplus of cash flow after the funding, could we use that extra money to get a working capital loan, and pull out as much as possible to build our own little capital pool, so to speak?
Yeah, I mean, we're all really debt financing really is. It's just how you underwrite that transaction, and what they're looking for is collateral, and that collateral can be cash, it can be working capital, it can be AR, it can be other assets in the business that, upon some kind of liquidity event, that can provide cash flow to the lender. So anything that you can help with their underwriting standards and improve that risk profile is going to get you through to that lender.
Right. Now, basically, who keeps the cash in the account after acquisition? Like you said, if I'm correct, if it's an asset purchase, the seller keeps it, the owner?
Correct. So the seller keeps the cash and the debt, and some of that can be negotiated, but
Mm-hmm.
most of the times they keep everything on the balance sheet. It's called a cash free, debt free transaction.
So when you're purchasing the assets are delivered free from any debt and any liabilities, right?
Correct.
If we're
Yes,
buying the legal entity, the stock, do we have to cover the debt?
you do. So when you're buying the legal entity, you're buying everything. So you're buying the cash in the business. So let's say if I had $1 million in liability, or if I had and then I had $1 million and $1.5 million in cash, I would pretty much use that cash to pay off as much of the liability if I wanted to. It's all mine. I can do whatever I want with it. But I do have both. I have the liability and the cash on the balance sheet.
Right. Could we use that to negotiate a lower purchase price because we're taking on debt? Essentially, we can't
Of
fund so
course,
much. Yes?
that's exactly what you do.
Okay, perfect. Now, when you're doing the asset purchase, like you said, the banks treat it as a new entity. If I'm correct, they look for 3 years of stability, of growth. Taking that into consideration that we cannot do cash flow based funding, how can we go about funding this?
Yeah, I mean, you can do. It depends on the size of it, but you can go get mezzanine funding, which is expensive. You're looking at like 15-20% plus, but that is an opportunity, and it's a little bit more sharky. You can just go get pure equity or cash to fund that transaction, just based on that investment thesis or that sponsor you're going to work with. So those are some different ways to go get some different kind of capital for that transaction or for that purchase.
Can you touch on mezzanine and what's it for? If I'm correct, this is more of a short term transaction at a higher interest rate.
It's a short-term transaction. It's a very high interest rate, but what it does is it helps your cost of capital in that transaction, right? So you're not purely just funding it via an equity, which is the most expensive cost of capital. You're blending it a little bit together by going to get some mezzanine debt and some financing.
Right. Taking into consideration, we can only offer what we can finance. Our ability to finance, or basically our offer, would be lower due to a higher interest rate and the smaller amortization rate, correct?
Correct. Yep.
Oh, okay. So let me ask you this. Let me see. Does the LOI grant you due diligence documents with off-market deals? And let me touch on this. Why I bring it up? So there was Ansi Monsión, who's in my partner, who's in this call. I'll introduce you after the call. But essentially, he had a situation where a broker told him that the PSA, you're only getting historical documents. You're not really getting due diligence. For you to get due diligence documents, you need a PSA, not an LOI.
So you're looking at, that's not an institutional transaction, right? So when you work with brokers, they're not
Mm-hmm.
really M&A bankers. So it's more about like small, family owned small companies. When you
Right.
go work in more of an institutional transaction, you will get to have a whole bunch of diligence. There's something called an exclusivity period where you can have 90 to 120 days of due diligence purely with you and the seller. And then towards the end of due diligence, you submit a purchase agreement.
Okay, let me ask you this. So if I'm going the off-market route, will a LOI grant me the documents? Once we got a letter of intent, I could request the documents I need to begin, our due diligence work, right?
What they'll probably do is, along with that LOI, they're going to ask you to give us some kind of bank letter or to give your assets and cash balance, so they know you're an institutional buyer, you're an equipped buyer.
Right. Mostly, they're usually asking for escrow. Now, I want to talk
Exactly.
about
Yep.
how can we connect with investors to make escrow at LOI,
How can you connect with investors to make what?
the escrow at LOI, or even to close the equity gap.
So escrow really, all it really does is it just means that you have the money, and there's going to be a third party called an escrow agent who's going to hold that money between you and the seller for this transaction. So it just shows that you're well funded. You've got the capital to make some kind of purchase in this transaction, and it's just giving you more credibility as a buyer.
I see. I want to ask you, based on your experience, how can one reach out to investors, connect with them? Usually, what do they look for, especially at such early stage, right?
So you're looking to work with private equity firms or VC
No,
firms?
independent investors, somebody with capital who reach out
Oh,
to,
just an angel investor. Yeah, yeah. I
yeah,
think the it's just really talking about your background, what you've done, why you're successful, why you're looking for capital. What are the ideas that you have in mind? What are the company targets that you have in mind? What's their cash flows? Giving them a full download of what they would want to hear or what they would try to do. And what that does, it helps you build your credibility, and it shows them that you're smart, you're thoughtful, and you're really looking at the right way on how to purchase a transaction or make an investment. So, it's really just being selective in who you reach out to, and doing your diligence, having the right process, and really showing them what you're capable of.
and, I want to touch on this. Is this possible? Could you make the seller basically the investor and him cover the equity gaps of the transaction?
Yeah, technically you can. That would just be, it's something called like it's, you just have some kind of recapitalization. So you don't fully recap out the seller. You just have him hold some equity in that transaction, so your purchase price either decreases. So yeah, that is one way. It's not a fully acquired company. You let the seller retain some of the equity, so your purchase price decreases.
Right, because sellers are taking in equity. So, if the owner, and I've seen it, mostly owners agree when it's an expansion model, the owner wants to stay after a transaction. So you become, so to
Yep,
speak, partners. You could pitch them instead of bringing somebody, an outside person to invest into a company to close this equity gap that could be 50,000, 200, or so on. Why don't you close the equity gap, right? And you can retain that equity until exit to liquidate at a higher valuation, or that money could be treated as an investment where you could get a higher return on it, right?
exactly. And then there's incentive for both sides there.
Right. Let me touch on growth and expansion models. Turnarounds. I heard those are very risky, especially if you don't have the proper experience or team to back you. We talked about this. And usually you need to put in equity from your end to get the business rolling. You got to pump in capital. What's your experience regarding those?
I love turnarounds because to me it's a challenge and an opportunity. And you're not going to get much worse. Like that's the way I look at it. Right, if you're going to go invest in the turnaround, yes, you do have to have that industry expertise, and you do need to be financially savvy, operationally savvy, because there's a bunch of cost savings, there's a bunch of things you can optimize going in right away. But it's not going to get that much worse, and I think that's where the opportunity is in a turnaround.
And let me touch on, there's I don't know if this was would classify as a turnaround, but a turnaround, if I'm correct, is a business that's in the negative, right? We're turning it around. But what if a business is just making ends meet, so to speak, and we're bringing in the management, so on? Would that also be considered a turnaround? That's just not in the negative.
That would be considered more of like a growth equity opportunity, right?
Okay.
So let's say I'm a company that's breaking even. What I'm going to do now is really going to just take in a whole bunch of equity capital or debt financing and really expedite my growth, and that'll help me either break even or really just increase top line revenue exponentially and quickly.
Now roll-ups, famous roll-ups. Everybody's talking about them. So, what does it take to do a roll-up? What is usually a time frame for it, and its execution rate? Like, can you, what are challenges to complete a roll-up? Everybody says, acquire 10, 20 businesses. but they don't really understand it because they've never done it before, right? Is anything's easy on paper.
Yeah. Roll-ups are tough, man. It's you have to really have an operational plan in place because remember you're going to buy 10 to 15 companies and they may have 10 to 15 different technologies, back office systems, different cultures. So really having somebody operationally savvy in place, really having the financial plan in place. So doing roll-ups, you also realize a whole bunch of synergy and cost savings right away. So what else can you consolidate, upon integration? And then, just having that right investment thesis. If you're doing a roll-up in healthcare, is it going to be just physician groups? Is it going to be dental practices? Like, how are you going to make that happen? What's the geographical location, proximity, all that stuff. So it plays into your investment strategy and thesis when you're doing roll-ups for sure.
Right now, I want to share with you the model we're looking to employ because after doing research, I saw that roll-ups basically, it's not what we're looking to do, but we're looking to move more into a buy and build, where, for example, we buy a physician model, and I've seen this in the larger physicians, $1 million plus, where they have multiple empty rooms. So what we could do is turn that single physician into a multi-physician model, where we can bring in, other physicians that provide services that work in conjunction to what is being provided there. Essentially, multiple services under the same roof. And the way you could structure a physicians is that they bring their own clients, and that's how they get paid. What do you think about that?
Can you repeat that last part?
Right. So essentially, let's say I buy a physician office, right? Whichever type. But there's 2, 3, 4 rooms that are empty. What we look to do is expand upon that business, basically capitalize on that, where we can bring in more physicians to offer multiple services under one roof, right? Customer maximization. And the way we would structure the physician is that they would bring in their own clients, their own customers, and they get paid through that, right?
Yep.
What do you think about that model?
So you're just really incentivizing the physicians to help in terms of client development, business development, and just helping to grow top line.
Especially, basically expanding the acquisition without having to acquire a whole nother business, right?
Yeah, that's really like more organic acquisition, right? So that's just around your corporate culture, around your growth strategy. I think that's the right way to really grow a business is to grow it organically. Obviously, there's opportunistic times when you want to do M&A. The thing is, if you do M&A, you better do a lot of M&A because it's really just about processes and having things in place to churn it. People who don't do M&A and try to get into M&A, they're never really successful as a business. So the best way is to really just try to grow organically with those ideas that you have.
So you'd say instead of, a lot of people are like, I want to acquire 10, 20 businesses. Instead of coming in and acquiring whatever businesses they see, acquire one and try to grow and expand that one. And then when you see the time's right to add another one, go on like that?
Exactly. That's a better approach. It's a more disciplined approach. And you have the operational inefficiencies figured out. If you need to go raise money, you'll say, here's why I need to raise money. I figured out all the inefficiencies. I figured out how to scale. I just need the money to go scale and expedite it faster.
Right. Well, Mars, I appreciate your time. There's no questions from the people. We've touched on all bases. Ansi, I don't know if you have any last questions. He texted me a couple which I asked you. But other than that, I appreciate it. Thank you very much, Mars.
Yeah, of course. Happy to help.
Yeah, so let me see. Ansi, you got anything or you good?
No, I'm good on my end. Appreciate it, Mars. Appreciate the time.
Perfect. Thank you very much,
Cool.
Mars,
No
once
problem.
again.
Thanks, guys.
Yeah, have a good night.
All right. Bye-bye.
Bye.
You too.
Well, guys, it took a week and so to get Mars on the podcast, but that was an amazing episode. A lot of value. Hopefully, we answered your questions. Nobody asked anything, so I assume we touched on all bases. With that said, I appreciate your time, and we'll see you on the next episode. Make sure to share and subscribe and hit that notification bell. There's a lot of people that needs this information, so let's try to grow the community. Have a good night.